Good afternoon. Welcome to the Monetary Policy Stance press briefing. Let us welcome the following BSP resource speakers: Monetary Board Chairman and Bangko Sentral ng Pilipinas Governor Felipe M. Medalla, Deputy Governor Francisco G. Daquila Jr. of the Monetary and Economic Sector, Senior Assistant Governor Iluminada T. Sicat of the Monetary Policy Subsector, and Officer in Charge Dennis D. Lapid of the Department of Economic Research. Governor Medalla will now deliver the statement on the monetary policy decision.
Good afternoon. This meeting on monetary policy today. The Monetary Board decided to raise the interest rate on the BSP's overnight repurchase facility by 25 basis points to 6.25%, effective tomorrow, 24 March 2023. Accordingly, the interest rates on overnight deposit and lending facilities will be set at 5.7% and 6.7% respectively. The Monetary Board's decision was based on the assessment that the sum of new information and the effects of previous monetary actions, since the previous monetary meeting warranted a continuation of monetary tightening to anchor inflationary expectations. With core inflation rising in February despite a modest decline in headline inflation, further monetary policy action was deemed necessary to address broadening price impulses emanating from robust domestic demand and lingering supply-side constraints. The latest baseline projections point on elevated fat over the near term. Average inflation is projected to settle above the upper end of the 2 to 4% target range at 6% in 2023, before returning to the target at 2.9% in 2024. The inflation forecast reflects the cumulative impact of the BSP's policy rate adjustments and the slower growth outlook on both the domestic and external fronts. Moreover, inflation expectations have increased slightly for 2023, while those for 2024 and 2025 remain near the upper end of the target band. The balance of risk to the inflation outlook for 2023 and 2024 also continued to tilt heavily towards the upside. The effect of supply shortages and domestic food prices remain a concern, while the potential impact of higher transport fares, increasing electricity rates, as well as above-average wage adjustments in 2023 point to the broader-based nature of price pressures. On the downside, the impact of weaker-than-expected global economic recovery continues to be the primary factor that could dampen inflation. Given these considerations, the board decided that follow-through monetary action would help ease persistent price pressures from here and abroad, as well as further realign inflation expectations with the target band over the policy horizon. Further policy tightening will also preserve the buffer against external spillovers and heightened uncertainty and volatility emanating from financial sector distress in advanced economies. Nevertheless, the BSP continues to keep a watchful eye over developments in the national banking community, even as authorities remain confident in the Philippine banking system's resilience to evolving conditions. Moving forward, the BSP reassures the public that monetary authorities remain ready to respond further to inflation risks in line with BSP's data-dependent approach to ensuring price and financial stability.
Thank you, Governor. At this point, we would like to request Deputy Governor Daquila to elaborate on the BSP's inflation forecast for 2023 and 2024.
Thank you, Alicia. In the previous policy meeting of the board held in February 16, our baseline forecast for 2023 was at 6.1%. We have adjusted that downward to 6%. For 2024, in the previous uh, meeting on policy, the baseline was at 3.1%. That is now adjusted downward to 2.9%. As the governor had mentioned earlier, the main reasons for the downward adjustment were, well, apart from the moderation of inflation in February, we also took into consideration the more challenging global growth outlook, as well as the cumulative impact of the BSP's policy rate adjustments. Thank you.
Thank you, Deputy Governor Dakila. We will now proceed to questions from our media friends. Should you have any additional questions or clarifications, you may send them through our FB broadcast, through text, Viber, or Messenger. So first, we will entertain questions from our media friends who are here in person at the BSP. So reminder, please, to stand up when you have a question, state your name and organization, and we will proceed now. Thank you.
Good afternoon. This is Keisha from Business World. Is this the last rate hike, or are we expecting more at the next meeting? Thank you.
This is where the praise, we are data dependent, is very, very apt. In the past, we were more or less sure that the next policy rate meetings would be another one, another increase. Now, clearly, now it really depends on the data. Because as stated, as I already stated, in the absence of new shocks, we think we are already moving in the right direction. Of course, that's a very, very big statement. So you can have a very optimistic scenario where the supply side actions work as best we could imagine. And in fact, we end up with, let's say, a negative month-on-month inflation. Then clearly, in that particular case, if we think that the other factors are already also quite well secured, then we might actually not increase next meeting. But it's too early to say. You know, we clearly a bad month-on-month result in this coming 2 weeks, right? Because the inflation rate for March is not will be out in first week of April. Anything, so this one very, very data dependent. Of course, as a Filipino, I hope that what we actually see is March prices were actually lower than February prices. By the way, February prices were actually the same as January prices, but if you adjust for seasonality, February prices are still higher than January prices. So these are the things that we'll be looking at. Of course, there could be developments outside the Philippines that could also significantly affect our decisions.
Thank you for that question, Keisha, and thank you, Governor. Our next question. Yes, please go ahead.
Hi, Gov. Good afternoon. Sir, the Fed raised interest rates earlier, yesterday, and there are indications that they're not done yet. Do you think that would be one of the signals that you will be looking at in the next policy meeting?
Well, in this particular case, we actually made the decision. Of course, the technical committee actually made a decision on 25, even before we knew, even before the Fed had met. So there are times when the decisions are not. The Fed decisions are relevant but are not the key factors. Again, in this particular case, the Fed decisions may be relevant, but if we have a very bad turnout of inflation this month, then even if the Fed pauses, we may not. In other words, to some extent, our policy actions are influenced by what happens in the U.S., what the Fed does. But to an even greater extent, it really depends on what happens to our assessment of the inflation picture in the Philippines.
Thank you, Governor. Next question, please. Thank you, Kai. Are there any more questions? Okay, since there are no more questions from the floor, we will
There's
proceed.
one more.
Oh, okay. Sorry. Please go ahead.
Hi, Gov. Good afternoon. We received some anecdotal information from people we speak with, supermarkets and that sort of thing, that in higher interest rates is now starting to bleed into prices. They've had to pass on some of their cost for the borrowings onto consumers. Of course, this is the prerogative of each supermarket, and individually they decide to do that. But a group has told us that it's already starting to bleed into prices. What can you comment on that?
But it's not clear what your question is. Is your question whether the interest rates, the higher interest rates themselves contribute to inflation? Some people actually take that theory quite seriously, but in our case, the impact on cost of interest rates is much the impact of interest rates on cost, and therefore the increasing prices is very low compared to the impact of higher interest rates in reducing demand and reducing inflationary expectations. So you may hear one or two anecdotes, but by and large, that is not the case. This is why we call it macro economics. So on the aggregative side, our own estimate is that higher policy rates, even without affecting expectations, reduce inflation. But when they reduce inflationary expectations, even more so.
Thank you, Governor. Thank you, Warren.
I have another question.
Please go ahead, Warren.
We were also speaking with some real estate developers, and they noted that they've already changed their direction because of higher interest rates. They've slowed down their development because of the higher costs. They also noted that there's a problem with inflation in construction materials. I know BSP monitors the real estate sector, but could you tell us any of the latest information you have regarding any problems in terms of real estate loans?
Well, there are several aspects to that. The first one is clearly the tightening of monetary policy has reduced demand. And we could already see that in housing loans. Indeed, housing loans are the biggest source of the slowdown in growth of loans. No, loans are still growing, but could have grown faster if housing loans had grown more than they did. Okay. On the other hand, the other aspects that affect the cost of housing would be, of course, imported price. And the way I see it, the slower global economy and the stabilization of the peso actually would tend to reduce the growth of cost. So really, to a great extent, the decline in the demand for housing and decline for demand, the decline in the growth rate of housing loans is clearly due to the tightening of our monetary policy. Now, in the short run, you can say that's bad for growth because there's less demand. On the other hand, to the extent that reduces the possibility of oversupply of housing and a possible greater fall of prices in the future, then that's not the case.
Thank you, Governor. We have two more questions from the floor. Yes, please go ahead.
Hi, Governor. Papa-clarify yung rate for overnight lending and deposit because it was faint kanina.
Okay, I would say overnight lending is 6.75 and overnight deposit is 5.75. Well, it's easy to remember. It's the policy rate minus 0.5 to get the overnight deposit and the policy rate plus 0.5 for the case of overnight lending. And that's why we call it the corridor. In the past, that corridor was wide. But as we improved the corridor, we made it narrower and the width of the corridor is now quite predictable. We have not changed it. When was the last time we changed it? Many, many years ago, right?
Several years back, Governor. That was the time when we had just introduced the corridor
Wow.
system. After we've
Yeah.
narrowed it, we've kept the band
Yeah.
ever since.
Indeed, what one can say is we're unlikely to change the target, but 2 plus or minus 1. And we're unlikely to change the band because there are many reasons why this is the current level, is that the current levels in our own assessment are the best possible settings. Of course, there will be, we will review periodically, but I do not see it being revised in the near future.
Gov, you mentioned that in the absence of new shocks, we are already moving in the right direction. I just want to get a elaboration on what direction this is.
Okay, in the average of new shocks, we should have below 4 inflation already
Okay.
by November or December. By the way, in the absence of new shocks, I used to think that is a good statement because a likely one, because in the past, the longest period above target inflation was just 15 months. In this case, even as late as the last 12 months, you can count the number of months where month on month was normal. Indeed, if you look at just say February to February, there's only 1 month where the month on month was consistent with 2 to 4% inflation. Indeed, there were months that were consistent with very, very high inflation, like January was 1.7%. Seasonally adjusted, it would be equivalent to more than 15%. So since the last 12 months, I'm now reluctant to say that for sure that there will be an absence of shocks. Just because we've had the first shock was March last year. First big shock was March last year. Just because the last big shock was already almost 12 months ago, I'm reluctant to say that bad luck has run out of bullets, Of course, if this were a 45 caliber pistol, it's run out of bullets already. But so this is one thing you will notice about inflation. And there are times when they come in very, very short bunches. There are times when they come in long bunches. Indeed, the longest shocks in the past were all on the low side. That's why we had a period where inflation was below 2 for more than 24 months. In fact, during that period, it was below 1 in 1 year. Okay, so what I'm saying is, if that kind of shock, if that kind of prolonged shock can happen on the low side, why cannot we now rule out that thing, symmetrical thing happening on the outside? Although the way I see it, it's hard to imagine what the new shocks could be, right? But it could be another shortage of fuel triggered by I don't know what, some geopolitical uncertainty, and so on and so forth. So that's why our statement is so conditional and contingent.
But given your inflation view that it will return to target November or December, and you said that bad luck may have run out of bullets, is a pause in the horizon maybe within the year?
Well, I'm saying it was the most extreme case is actually March prices were actually lower than February prices. So you're now beginning to see negative, but wait, seasonally adjusted. You're now beginning to see negative month on month, which we have not seen for a long, long time. So now, is that likely? I don't know. But if something like that happens, we have to change our mind. But similarly, the shock can be, as in the case of January, outside, in fact, our 95% confidence interval. So January also teaches us a lesson. The shock can be something you do not expect if you were just looking at 20 observations, but it happened.
Last na lang po. I know you've been sending statements also and notes on this, but I just want you to explain what do you think is the impact or non-impact of the recent banking crisis on our economy and future policy moves of the
Okay,
BSP?
the simplest answer is no exposure, no or insignificant direct exposure of banks. And if people are exposed, it's their clients in the trust department, not the banks. So the banks, therefore, from that direct, simplistic point of view, walang impact. The more subtle question is, since what got to the Silicon Valley Bank crisis was the rise in US policy rates, causing bond prices to fall, causing the bank to take losses, won't the same rise in policy rates, which is happening in the Philippines, also cause the same? My first answer is, although in terms of absolute increase, we're similar, in their case, they're coming from a very low point. If you're coming from zero, any increase is in percentage terms infinite. That's the first difference. Okay, 1%, consider a bond that has a very, very long horizon. And it's paying 1 peso per 100 pesos. You have the coupon is 1. What happens when the interest rate goes up from 1 to 2%? So now you can find a bond that costs only 50 pesos, that pays 1 peso as well. So therefore, the old bond with the old coupon, the value will fall by half. So that's the problem when you're coming from very, very low interest rates. In the case of the Philippines, we never came from that low interest rates because even when we brought the policy rate down to 2%, the markets, of course, were aware that the 2% was temporary, and therefore bond prices did not rise too much. Okay, so in that sense, from the point of view of markets, we were coming not from 2%, but from more like 3 to 3.5%. The second is we do not have 30-year bonds. Okay, our bonds have shorter duration. The third one is our banks hold, for instance, the share of loans in bank assets is much higher, 70%. 70% of the money of banks is either loans or deposits in BSP and other banks. If you look at the bank that failed, it's exactly the opposite. So therefore, from that point of view, clearly the impact of the same 300, 400 basis points is different. The second one is that our banks are actually better regulated. Because the problem with the Silicon Bank is that it's a regional bank, and there was a law that I think a regulation was passed that the regional banks were exempted on the mark-to-market. So therefore, the losses were not recognized and festered there. We do not have the similar problem. And then, of course, because our banks are also, I think, very well governed, they did not take that kind of very large unhedged risks. So therefore, what happened in the US, where policy rate increases could hurt the banks, is not true here. Of course, although it hurt the banks. But remember, the banks also gain from the higher interest rates, income-wise. Okay, so therefore the impact on the bank is much smaller. So that's the other. Now, how else can it hurt us? It can hurt us, of course, if it becomes the repeat of 2008. But I don't think that will happen. The Fed has taken a lot of actions that will prevent that from happening. For instance, they have actually made nearly all loans, not nearly all deposits guaranteed. So there will be no runs. Second, they've also said the banks can borrow from the Fed at par, meaning walang mark-to-market for the guarantee value of the bank. So I think the Fed has essentially contained the effects of the failures on the U.S. banking system. So those altogether means that it's not gonna happen here. That doesn't mean, though, that there are no shocks that can come from nowhere, right? Because this is what we learned from history. The next shock is something that is different. But at the same time, I think the resulting stock market reaction is really a reaction to news that even the Philippine stock market reacted to those things. But I think that's only very natural. The stock market, of course, react very quickly because these are people who are very, very sensitive to news because they watch everything closely. So we think that we are the so-called banking problems in the U.S. are not going to be a major issue in the Philippines.
Thank you, Governor. Thank you, Andrea. We have our last two questions. Thank you.
Governor, with the 425 basis points total rate hike since May last year,
Yes.
how do you see growth, economic growth in the first quarter?
Well, our own nowcast is how much? Is almost 7%. Whereas our it's called nowcast because we are forecasting a quarter that has almost already happened, but the data comes a month late, right? Now, on the other hand, our forecast for the year is about 6.5, right? So the as we pointed out, one of the reasons that inflation did spread quickly, relatively quickly to other sectors, is that the other sectors actually already facing very large demand. Okay, the best example is the rise in restaurant prices. How can they afford to raise prices? Because they got some of the restaurants and queues. I will not mention which restaurant. I took out my family to eat last Sunday. We ended up eating noodles because the 3 restaurants we went to said the waiting list is 14. Yung isa sabi 14, yung isa 10. So in that sense, that's the reason the higher policy rate so far has not really been a major downer in growth. Demand is still quite strong, especially in some sectors. Now, things may be a little bit more difficult 2024 when the pent-up demand effects are weaker or waned, whereas the global economic growth may be more of a factor.
Thank you, Governor. One last question from the floor, and then we will move on to our questions sent in advance and questions from our online audiences. Thank you.
Thank you. Gov, this is a phone-in question. People are wondering when they're going to start seeing these hikes in the deposit, the rate that they earn on their deposits. People see it in time deposits and whatnot, but what about savings? And when do you think that? Or I know it's a prerogative of banks, pero when do you think that's going to happen?
Well, by the way, my own assessment is if you have large deposits, whether your savings or current, you have the option to leave. you get a better offer. So, like it or not, that's the business model. Because if your deposits are, say, 10,000 pesos, you will pick the bank not because of the interest rate, but because of maybe location. Yeah. So unfortunately, that is the way it works. The big deposits, I think the big and mobile deposits, I think have already gotten the increases. But if you're depositing, if your deposit is even 100,000, 200,000, you're unlikely to move to a bank that's further away, or a bank whereas in this bank you like the branch manager. So that's the nature of the business.
Thank you, Governor. We will now move on to the questions sent in advance.
Francis is something to add.
Okay, we have a comparison of the average time deposit rates. This is for short-term time deposits. We're comparing May 2022 as against February 2023. So the average for May 2022 was at 0.58%. For February, it's at 3.68%. So that's a difference of 310.5 basis points, or 3.1%. For the long-term time deposit rate, in May 2022, the average was at 3.01, and February 2023, the average was at 5.14. there's a difference of 212.4 basis points. So that illustrates that there has been policy rate passed through
Yeah.
to bank interest rates. Actually, not only that, but to the effective lending rates. There has been passed through.
Yeah.
Thank you.
In other words, if you're looking at deposits, large time deposits usually not be small, right? So you will move your money, therefore you get a better offer. On the other hand, CASA, you current account, savings account, which is usually a joint one, right? You just transfer your money back and forth, the other one, depending on your needs. You have there are other things that attract you to the bank. For instance, I have my deposits in PNB here in DSP branch, and my main concern is not the interest rate, but accessibility. And besides, my deposit is not large. Huh? So those are the really you expect the nature of competition to. Also, the bank also has to spend quite a bit of money running the branch. I was told that the cost of branches easily adds to 1% to the cost of money. So that's the other way to see it, that if you're a small deposit, it's in general calculation of costs, then you will get a lower pass-through.
Thank you, Governor. Thank you, DG Dakila, for our questions sent in advance. First question from Lee Chipangyan of Manila Bulletin. Governor Medalla, do you think the BSP still has room for further tightening given inflation is still on the high side?
Well, in terms of room, the question is that will raising rates have such a high cost to society that we will hesitate to do that even if inflation is high? The answer is no, because we have looked at the cost to society of the higher rates. It's not that high. Okay, what's your estimate on effect on GDP? Points. 25 basis points only means 102.
For a 25 basis point increase this March, the impact on GDP growth for 2023 will be about 2 basis points.
Yeah. And as I said earlier, the back balance sheets are strong. So the speculation in the US is that the banks will be weakened so much by policy rate increases, the Fed will be more reluctant to raise rates. That's not the case here. As I already said, Philippine balance sheets are strong. Okay, so therefore, that's why anchoring inflation has our highest priority, because the negative side effects of doing everything in your power to anchor, to make sure that inflation are well anchored, and therefore inflation will take a target consistent path is of the highest priority, because the cost to society of the others side effects are actually quite low.
Thank you, Governor. Thank you, DG Dakila. For our next question, also from Lee Chipangyan, should we be concerned about global interest rate volatility amid banking issues, and what could be its impact on the local banking system? And we have a similar question from Siegfried Aligado of Bloomberg. Was the impact of the banking turmoil asked, and how could it affect the domestic economy and consequently policy decision in the future?
I already stated that the way we see it at this point, the banking problems in the rich countries, they will not have large effects on the Philippine banking system because the different situations. Okay, one is a 100 basis points increase in policy rate is smaller as a percentage of the initial policy rate than in the US, where the starting policy rate was much lower. The other one, of course, is that, as I already said, the holdings, the bank holdings of government securities is much smaller. By the way, one good example of that is just the placements of the banks in BSP is already what? If you include required reserves, that will be what? More than what? 1.3 trillion plus 2 trillion. Okay, so they're not exposed to government securities, and of course, their exposure to loans much higher than their exposure to government securities. So those are the factors working in our favor. Of course, that also means, though, that if loans turn out bad, then our banks are more exposed. But even in that case, they have high capital adequacy ratios and already have very high loan loss reserve provisions.
Thank you, Governor. We now move on to questions sent by our media friends online from Darlene Basingan of MNA and July Rada of Manila Standard. When was the last time interest rates reached 6.25%?
Oh, that's a long time ago, no? Before I joined the Monetary Board. So let's ask people who were here before I was here. So, Ilan?
Governor, the most recent high that we saw was in 2008, in November 2008, 6%.
6%. So you have to go back, you go beyond earlier than 2008 to see anything like this.
Thank you, Governor. For our next question, this is a question from July Rada of Manila Standard. Did you consider the latest similar question? Did you consider the latest financial turmoil in the US in your latest policy decision? HSBC earlier said the BSP could still hike rates until May this year because of the liquid financial system.
Yeah.
What is your take on this?
Well, as I said, we look at it, but considered it not to be an important factor. Now, therefore, we have the luxury of being focused on inflation. And our actions will be almost completely driven by our outlook on inflation.
Thank you, Governor. So far, this is the last question. So I'd like to ask anybody if there's any more questions. We will answer them after this question. This question is from BPI's June Neri, asked through our Facebook page. Should the price environment improve significantly later this year, will BSP cut the policy rate immediately, or will we rebuild our JR buffer first to ensure currency and price stability amid growing imports?
Okay, we're easy to talk about when we might pause, but when we will start reversing, that will require quite a bit of data. Now, what will cause us to reverse? Okay, an extreme case. The price index does not change from now till let's say July or August. Of course, it's an extremely unlikely case. So not only has inflation going down, the price themselves not going up on a month-on-month basis. And then clearly, in that case, we may consider. But we do not. That's not a very likely scenario. The very likely scenario is we will not we will not cross 4% until, as I said, November or December this year. So therefore, any reversal of the tightening will probably have to happen after that.
Thank you, Governor. We have our last two questions. First, from Lee Chipongyan of Manila Bulletin. I think she wants a reiteration, Gov, of what you said earlier. What worrying shocks are you watching out for at this time?
Well, the thing is, you learn from history that what you're watching out for doesn't come and something else comes out. So I think the solution, the real correct response is to be vigilant and not to be complacent. Of course, for instance, a major geopolitical shock, which I don't want to describe very clearly because otherwise I'll get calls from embassies. That has implications on imports, trade, and also possible financial flows, right? So if there is a large geopolitical shock that is very close to the Philippines, like that's not, we're not sure what will happen. But fortunately, that's the reason we have high reserves, so that when something like that happens, then we do not have a sudden stop that is so damaging to the economy.
Thank you, Governor. We have a last question from the floor. Yes.
Hi, Gov. Ditas Lopez from Bloomberg News.
Hi.
Gov, based on Bloomberg data, the peso is now the best performing currency among actively traded currencies in Asia year to date.
Year to date, yeah.
Will that have, will the favorable impact on inflation going to be significant? And why? Thank you.
Well, that's the reason I'm saying that if you just look at currency alone, then we have done what must be done. But remember, that's the view now is the US is going to do little left, you know? So if the US then changes policy again, then that will no longer be true. Maybe the peso will weaken again. In addition, we expect relatively large current account deficit this year, which is what, $17 billion? Yes, and if for any reason there's a risk the global hedge funds and investors are on a risk off mode, they're afraid of anything that's not safe haven, then the situation can quickly reverse. Okay, so of course 17 billion and the normal course events will be financeable. Like FDI alone could be what, 12 billion. Loans of the government, portfolio inflows. But it's too soon to speak that just because the peso is strong, the first 3 months of the year that will be the case for the rest of the year. Indeed, we have scenarios where the peso will actually slightly weaken rather than strengthen. No? So ang dami pa pwede mangyari. Ang pinakamahirap i-project lahat exchange rate. Kasi kung madali yan, madali yumaman.
Thank you, Governor. If there are no more questions, we would like to thank our speakers, our media friends, and those watching us live on Facebook for their time and attention this afternoon. Maraming salamat po.
Thank you very much.